Hello and welcome to another episode of the Swing Trader Status Update. This is our weekly chance to kind of check in on some of the stuff that's going on our Swing Trader product and really kind of share a lot of what we're doing on the swing trading platform. So it's December 10th. 2024. It's a Tuesday, and joining me as he usually does is Mike Webster, our chief market strategist or director of market strategy or senior market strategist or
My,
hey, the guy that
my
joins me.
card says officially just some random dude that they let on
Okay.
there every once in a while.
I was going
So
to say, you have a business card? Because I still don't have one. I think I need to
no,
get one of those
I don't have
eventually.
one. Do they still make those things?
I believe so. I've seen them around. So, well, we've got yeah, we've got an interesting show for you today. One of the things that we're going to talk about a little bit is this whole idea of, gosh, it almost invariably happens, Mike. Whenever you have like a great month, a great week, it almost invariably happens that you get a little bit of a pullback, and that's
Mm.
kind of what we saw, over the last couple of days, especially to the heat, and we really got some. Pretty dramatic drops in some of the stocks that were the leaders of this latest cycle. So let's go ahead and jump right in, and I'm going to pull up the Nasdaq Composite just to start there. And really, yesterday didn't look all that bad. But one of the things that we kept on looking at was, man, if you looked at like the IBD 50, this is the Innovator FFTY IBD 50 ETF, that was down 4% yesterday and 2% today. So the NASDAQ is not quite showing some of the destruction that's happening in some of these high flying stocks.
Yeah, there is an appetite for some destruction out there today.
I see what you
So
did there.
I couldn't help it. Look, let's go back to the FFTY for a second. Now, this is something we normally look at, but it was starting to kind of perk up out of this cup with handle and starting to look the way it used to, years back when it would, kind of lead and have, a lot of our type of stocks in there. Um, and then it's really, I think it did a really good job showing yesterday and today how our style, the IBD methodology, heat was hit on balance pretty hard, and that's normal and natural. We're always looking for what's abnormal. Um, and look at this pullback. It looks very similar to the pullback that we had after the cup with handle breakout. It's never fun. And that lasted 4 days, but really the bulk of it was over 3 days of selling. And that's what you normally, that's kind of your game plan. When you see a bad day like we had yesterday, your immediate thought is, okay, this is day one of 3 days worth of pain, and you start adjusting. But then there were a lot of cross currents in there, so it wasn't really. Let's pull up SPY for a second to kind of show how different that was. So SPY was just hanging in there, just this tiny little down day. Let's pull up the cues. I do have a position there. Um, with that, I believe I still have. I shut down my brokerage account, but I believe I still have some in there. And that was just a little baby inside day, but yet you have what was going on with FFTY and a lot of the names that we look at. Let's pull up APP, which is like, you know, been the leader since September 11th, uh, and that was getting hit pretty hard yesterday. How much was that down? Over 10%, I believe.
Yeah, it was uh,
Yes.
14.7%
Yeah.
yesterday,
And
and
then
then another 6% today.
yeah, and let's look at Kava, which was one of my favorite stocks, still is. I exited the position. We exited it yesterday, right around 140-ish, give or take. As it was starting to, we were just seeing an abnormal breaks in a lot of the heat, as well as a lot of the restaurant stocks. So it was just telling us, what, this thing is probably has to base build. Well, I was trying to be as patient as possible with it, but that RS line was crashing through those short-term moving averages on the daily chart, and it was just time to step aside and let it do what it needs to do. And we'll, come back to this. I don't think this one is done, but I think it's done for now. And when you get that type of selling, it just probably needs some time to form some sort of formation, and we'll wait and probably pay 140 or higher for it when we buy it back at some point. But there was a lot of this going on. So let's go back to the FFTY. What would be normal in this case is when you have um, two bad days, is typically you open up weak the next day, and lots of times that will be your bottom. You kind of either get an upside reversal or at least kind of a mid-range close. That would be what's normal and natural, and staying above that last low that we had there, kind of where your cursor is. Um, that would be normal, and then you'd move up. And what would also be normal is to take out the highs that we had a couple days ago. So now you know what would be normal. Anything abnormal, abnormally stronger than that or weaker than that, then you want to adjust. So what we did, given really that backdrop, more so than what was going on with Nasdaq and the and SPY, is we backed away from a lot of the heat. Let's pull up Reddit. That was something that we trimmed a lot of yesterday. We sold 3/4 of it yesterday, left a quarter of it on today, just trying to see if it could firm up. Because, in yesterday's tape, that's still being up on the day. How much was that up? Maybe 3 or 4%, something.
Yeah, it finished up 2.7.
Okay. So given what was happening in the rest of the heat yesterday, that was really bucking the trend. So we were trying to give it some space, but also it was, we wanted to lock some of that in there because we saw that, this could happen. And frankly, this could come down and touch the green line, the 21 day, and still not have done anything wrong. But when you're swing trading versus position trading, you really can't give it all that much room. So we backed away from this, wanting to get back into it once it sets up. So a lot of the things that we sold today and yesterday were things that we want to get back into. We sold our QLDs and our FNGG. Let's go to the FNGG for a second. Did you have something to add there,
No,
Justin?
I was just gonna say I thought FNGG would be a good thing to take a look at, and that opens up a lot of things to talk about in terms of where some of the strength is kind of surprising, in Google and Apple and things. But we also have Broadcom as a big position in FNGG. So Nvidia. So yeah, go ahead and talk a little bit about this and the decision behind that.
Yeah, so this was a tough call because I still have some of it in my own account, but I wanted us to remove it from SwingTrader today, just because um, a few things. Pull up Nvidia, which is this ETF only has 10 stocks. They're all 10% positions. Nvidia is one of them. And I like Nvidia a lot, but it looks like it needs a base build. It's underneath the 50-day. That RS line is underneath its short-term moving averages on the daily. And it just feels like it needs to either have a catalyst, which the Broadcom earnings could be later this week, or could be a positive or a negative catalyst, or just puts in time. Now let's go over to Broadcom or Avago, that some people call it, because it confused us with putting the Avago's symbol and Broadcom name. I don't know. That was silly. But this is a nice double bottom, and it broke through our 50-day 2 days ago. Had your shakeout, Livermore shakeout +3 that went on. That still could be held, but with earnings in 2 days, we didn't want to have a position in that just because it's a crapshoot. It could gap up 10%, it could gap down 10%. And that's really why we backed away from the FNGG. We thought that whatever happened to Broadcom would spill over to, let's pull up TSM, Taiwan, as well as NVIDIA. And then, if it's a bad report or looked at it in a negative way, those would come in, probably bring the Qs in as well, probably be below our threshold that we would have had to sell things lower. So we just decided to go ahead and lock in those trades now with FNGG and the QLD, looking to get back into them. Now, if we have time, we'll take a look at the my regression lines, and then we'll talk about the SPY there. But what was some of the other stocks you wanted to talk about, Justin?
Well, since we're kind of talking about the weakness in Nvidia and the risk, I guess, with Avago or Broadcom, whatever you want to call it nowadays, Broadcom officially. Let's talk about Google, because we do still have exposure to that FNGG. area with Google and Apple both looking surprisingly strong, given how ugly things were looking for most of the market. So this was actually kind of making the indexes probably look a little bit better because both of these are such heavyweights. Meta, I'm going to go ahead and add that to the list, which we still do have a position on SwingTrader for that. I have a position in this as well. Tesla, I have a position in this as well, and this is still. Is this in that FNGG?
No.
No, that one's not. Okay.
Yeah.
But you do have some of these trillion-dollar companies that are, I guess, helping the index not look as bad as it could.
Exactly. So I do have a position in Tesla as well as Google.
And I do
Um,
have a position in Google as well.
yeah, and so the Google, that's something we put on today, and I was surprised, frankly, with its reaction because that base we went over it on IBD Live in detail, and it's not a perfect base, but it's the pattern itself. The cup with handle is very crystal clear, which gives you a clear expectation of what would be normal. Normal would be we move higher tomorrow, or we have an inside day tomorrow. Now, an inside day is kind of tricky with a gap up because there's an inside day from today's trading action, which would be kind of tight. And then there's an inside day from today's true range, meaning from yesterday's close to today's high. That could also be in the cards. If that happens, we'll probably have to back away from some of it, if not all of it. But if it just has an inside day within today's bar, we'll hold on to it. But that looks just normal. Like that's a classic breakout with a mega cap stock, and with the Apple doing what it was doing, looking like it wants to go higher. That's why I'm not negative at all on the averages, but I still think we could, with the selling and the heat that we had this week, still see some pain before we move higher on a broad basis. So what we did to keep our exposure up and not get it too light, because we did back off a margin, we put some slow things on like the RSP, which looked a lot better at the time that we put it on intraday because it had an upside reversal, or it was hanging right there at the 21 day, the green line. Then it got weak near the end. But this is so much slower than a QLD or FNGG. So it was, I'm kind of looking at it as a source of funds. We put it on there as a placeholder because this gives us exposure to the broad market that on balance was still looking good, but this was also in a position where it had come down for, a week and a half, which puts it in a position to be able to bounce up unless we're in real trouble, which then if we're in real trouble, we'll sell this and we won't get hurt as bad because it's not a double and it's so spread out. So that's one of the messages for today was when you're in times like this where you get a lot of things selling off, look around and see if there's some lower risk entries that you can find, like the Google was a lower risk entry. The RSP was a lower risk entry. We also did something with IWM via the UWM, the double, and I have a position in the
Yeah,
TNA,
I have a position in that as
which
well.
is the
And maybe talk a little bit about this because look,
yeah.
the Russell 2000, it's almost like the rom-com, will they or won't they? And this has given a lot of false starts. And some of these have been powerful, but
Yeah.
just very short lived.
Yeah, so with this one, I typically buy it on breakouts, and they're very prone to shakeouts with this particular instrument. So let's go back to the daily on this. How I was looking at it is I was trying to keep our exposure up as high as possible in things that made sense. This is 2,000 stocks. It's spread out. It was firming up right around the 21 day. That was kind of our guardrail, as our good friend Jim Ropa likes to call the 50-day for individual stocks as a guardrail. For this one, or a lot of things, I use the 21 day as a guardrail. And so it was right there at that green line where it should get support. And this is, drifted down like the RSP where it's kind of been out of favor for a week or two. And it seemed like it was logical for this rotation to go into it here. Now, in the last hour, it sold off more than we wanted it to. So it's, we're on the fence of, getting ready to cut it loose. But again, by buying it when you're near the 21 day, then you don't have as big of a loss if it goes against you. And that's kind of the rotation that we were doing this time, is going into things that have kind of you're very close to where your stop would be. So if you got in there and it didn't work out, you could just exit rather gracefully, rather than, you know, buying a big breakout that's extended that could continue a lot higher, but you have a long way down before you know that you have to pull the plug on it. So that's where we're doing this rotation. Rotations are tricky and hard. Nothing fun about it, frankly, but it is what it is. It comes with the territory. Let's go to the composite on a weekly.
Real quick before we go there, this is a great question that came from YouTube. Our good friend Tim. I'm not sure if you got to meet Tim in Las Vegas for the
Oh, I'm
Founders
sure
Club.
they
He
do.
was there, but he brings up a good question. Why go into some of these lower risk stocks or areas with lower ATRs instead of just stepping aside completely and waiting for the market to kind of show a better signal?
You could certainly do that. There's nothing wrong with that. That is an approach that makes a lot of sense, and why I always say you don't feel like you have to follow along with everything that we're doing. But the reason why I was wanting to keep exposure up is, let's go back to SPY. We're still in a solid power trend. You know, we're still, our low is still above our 21 day. 21 day is still, a mile above our 50 day. So we've got a lot of room there. And if you get too cute with things, and reduce your exposure too much, if this ends up being the type of bull market that I think we're in, you're going to get such low exposure that then you're forced to chase and you get that FOMO. So I'd rather be in an RSP and a UWM with some of that cash of kind of locking in the heat. Well, I think it's going to come down a little bit more, or moving it into a Google that's kind of in my opinion, a solid breakout, or some other things that we put on today that I think we don't have to go through our entire book, but some other things that I think look good. I like that type of rotation because I'm always looking at how deep in the market are we, and that's why
Mhm.
you and I and Charles Harris came up with the market school rules, and we're still at 100%, there, and we closed, I believe, at like 74% invested. So with that, I'm feeling like I don't want to get too far away from my bogey. My bogey is, my target is 100%, and our bogey SPY is 100% in at all times. I don't want to get too low, because if we get some, let's say we get a really positive reaction on Broadcom, or I think Costco's reporting, or some other news that comes out. I think we have CPI this later this week. That if we get a move up, and let's say we had sold it down to 40% invested, now trying to get back to 120%, that's a mile away, and then you're having to do a lot of movement. So it's a very good question, Tim. Feel free to do it the way the way you feel comfortable. Everyone should not just mirror what we're doing. It's just a learning experience, or it's a teaching experience of what we're trying to do, of one variation. And my own account, I position trade as well, as what we do with the leaderboard product, what the guys do over there, where you're holding things for a longer period of time and building, more concentrated positions. So I blend the two. But
Mhm.
for this product, we're talking about swing trading.
Yeah. And, just, as a point in reference, one of the metrics that we kind of look at for the model portfolio of SwingTrader is we look at the weighted average of ATR. And because we were on margin, that was going higher and higher. We were over 4 for the portfolio, which is high. We had a lot of heat, and we were trying to balance it out. But when that heat started taking the hits, we're at what, half
1.5.
of it now? We're
Or
at
less
2
than half. We're at,
2.1
I
in
think
terms
we're
of
at
the
a one.
ATR for the portfolio.
Dominic sent me the last thing at 1.52.
Oh, okay. So
Yeah.
even more. So
So do you
came
want
down
to
even more.
explain what that
Oh
that
yeah, that's because we took off QLD and FNGG at the end of the day. So
Exactly.
Yeah, that brought it down from 2.1. And so again, now cash is acting as a zero ATR and bringing that down. So yeah, we're less than half of the ATR that we were at just 2 days ago.
Yeah, so just if people didn't pick up on that or what you were saying, we're looking at the portfolio on a weighted basis of what the true range would be to give us an idea of how much a risk we're taking. Like some people like to look at the beta of their account. I think that's very problematic. I think that the average true range, meaning you take the average true range of all of your stocks in there and you weight them or ETFs and weight them accordingly. And like you said, we have a 1.52 average true range on the model portfolio versus a couple of days ago we were up over 4%, which we put it over 4% for a reason. We wanted that heat because we were in the part of the regression and in the part of the market where we were moving up and we wanted to gun it as hard as we could. And I really didn't want to get much past like a 4.5% ATR, and we didn't. And then so now we backed it down on purpose, methodically, and we'll ramp it back up because I think after a day or two we'll be back up and we'll be on margin. But I'm not going to tell the market what to do. We could be in for a trip to the 21 day, and if so, we've positioned ourselves, you know, in a proper way because this looks like a setup day in reverse
Yeah.
where you have a wider spread today, kind of a lot different than a setup day on a stock or an ETF that's going to move higher. Those are typically a tiny little spread closing at your highs. Expectation is you're going to go higher the next day. This one, we've got a wider spread than yesterday, closing at your lows underneath yesterday's low. That tells you you're in a weak position, that what would be normal and natural would be for a move lower tomorrow. And then you just always have to ask yourself, okay, where are your stops? If you get a move lower tomorrow, if you get a gap down, are you going to just be triggered on a bunch of them and be forced out at worse prices? You're better off just doing it ahead of time as long as you're flexible and willing to buy things right back. If things, we kind of did this a week ago, right before that big blue bar there, or the tiny blue bar on that pink day. It looked like it was going to come in, and so we did some selling. And then when we moved higher,
And really the selling started on the Wednesday because it was
oh,
kind
that's
of,
right, yeah,
oh yeah, let's book some profit. We
yeah,
were kind of up at the at our dashed line for our regression channels that we went over last time. So we were, kind of up at that level. And then kind of what turned it was the Friday positive expectation breaker. When
yeah.
we crossed that Thursday high, that's when we kind of started gunning it again. But yeah, between Wednesday and Thursday, you're right. We did come off a little bit off of as much margin as we were on, and we're a lot lighter.
Yeah. So, um, what people should learn from this is one style where you're very active and your core thing is, I know we got some comments of like, why do you guys talk so much about the market and not so much about individual stock setups? Is because a large part, the bulk of what we do is based around what the market is doing. And that dictates how deep in the market we want to be and what types of stocks and ETFs we want to be. So that's why we focus so much on it if people are wondering. But with this, it just looks like normal and natural would be down. Abnormal would be just to move through today's high. So you just kind of, you're trying to be proactive there, but we'll take it one day at a time. I'm looking to get back on margin as soon as we can. But we just have to have the right setups.
Yeah, and just being aware that, look, we could come in more while the expectation is 3 days would be normal. It could be 4, 5, or look, we could be having a visit below the 21-day moving average line. We don't know at this point, so we're kind of positioned to, if we get a bounce yesterday, tomorrow, or the next day, we're kind of in a position to use those sources of funds, as you mentioned, to not get too far behind, but at the same time, we're in a defensive position that, because our ATRs are lower and more in line with SPY, we shouldn't be getting overly hurt compared to that bogey. So, anything else that we needed to cover before we took off. I know you've got to catch a plane, so any kind of
Yeah, I
last.
mean, I guess I could share the regression just very briefly.
Okay, go ahead. I'm gonna end my share and let you do that as long as long as you really keep it brief.
I know.
Hey,
Okay.
you're the one with the plane to catch.
I know. Okay, so you can see my Nasdaq
Yes,
Composite. I'll be very
Nasdaq
brief,
Composite.
and we'll go over this again on Friday with Ali on the SMT after the close. But just wanted to share with everyone where we're at. So this is the Nasdaq, and this is still looking normal, where we came up to our half um, zero point 0.5 standard deviation right here, which is our red dash line. And so now it feels like what's normal would be a test of our regression line, which is our white line, which would be a little bit lower, but still well above our 21 day. So that's looking fine. On the Qs, we're back underneath our regression line, which is one of the reasons why we were taking the QLD off, because we had undercut and closed below yesterday's low, and yesterday's high was essentially at the regression line. So when you're in this position, your assumption is that it wants to travel down to its next level, which is the green dash line. So that would be kind of painful if that happened. And that's why we backed away there. But really, why I wanted to bring this up was SPY. SPY had been bothering me here because at this point we should have run up to our white line or our regression line, and it didn't. And it just started kind of just going right in line with our 0.75 standard deviation, just a little bit above that, the green dash line there. Now we close below it. So it feels like it wants to test the one standard deviation right there. That would be normal and natural. If we can do that and then have it come back through our green dash line, we're going to gun it hard with the expectation that we come back up here. It is worth noting that the IWM, I've changed the regression on here. We don't have 50 days yet. I'm just starting this off on October 31st, this low here. But this one is down to our one standard deviation, given that short amount of data that we have here. And that was why we were trying it, because the assumption was at, at the time it was up near the 0.75 that I thought we were going to go up to the white line. We still might do that. We're not
And
sure.
we were also bouncing at the 21-day moving average line, so it's kind of a double whammy there.
Exactly. So that's all I had on those. I'll stop the share. See, I can be quick when I have a
You
point.
can do it. All right. Well, that's going to wrap up this episode. Again, it's been a very tricky market. If you're interested in kind of following along with what we're doing, you can always take a trial of SwingTrader. You know, that's on investors.com. You can just click on the SwingTrader links there. But thank you very much for joining us. We hope that everyone is staying safe out there, protecting your portfolio, but not necessarily getting too bearish, because we are still in a very solid uptrend here. So again, it's not bad to take some defensive action. You just don't want to overdo it or not be ready if things turn around, which they could very easily do. And definitely watch that Friday SMT because Mike is going to go over a lot more of this with Ali on Friday. Tomorrow on the podcast, I've got Laosh Makolka, who's going to be joining us. He's really killing it in the U.S. Investing Championship, so it's going to be great talking to him and finding out what he's doing. And he's not even a full-time trader. He's got a full-time job, and he's doing the trading on the side and really
Wow.
still doing very well in that U.S. Investing Championship. But you know what? One of his secrets is he lives in the Czech Republic, and so market starts at 3 p.m. for him right after his after his day job. So
I love that
yeah,
story. I cannot wait to watch it. That what a success story,
yeah.
man.
So
Tell him that the guy out in Austin is very proud of him.
yeah. So anyway, well, thanks a lot for watching us this time. I apologize that we were a little bit late, but I think we might have fixed our pixelation problem. So we're crossing our fingers. So I hope you got to see me this time around on the live show. But we'll get this up and running in a high resolution for you. And thanks for watching. We'll see you next time. Bye now.